the complete guide to Bitcoin and altcoin pump and dump cycles. Introduction. Understanding market volatility. Cryptocurrency markets are extremely volatile, with sudden price increases, pumps, and steep declines, dumps. This guide will explain the key reasons behind these movements, how to predict them, and how to profit from them while avoiding major losses. Part 1. Understanding crypto market cycles. The 4 phases of every crypto market cycle. Every cryptocurrency goes through predictable cycles. Accumulation phase. This phase occurs when prices are low and smart investors start accumulating Bitcoin and other cryptocurrencies. Market sentiment is usually negative and trading volume is low. This is the best time to enter the market before a major uptrend begins. Bull run. Pump phase. In this phase, prices skyrocket as demand increases, driven by positive news, institutional investments, and retail FOMO, fear of missing out. This is when new investors start entering the market, pushing prices even higher. Distribution phase. This phase occurs when large investors, whales, and institutions start taking profits. Prices might still rise slightly, but momentum slows down. It's a critical period where experienced traders start exiting to secure their gains. Bear market, dump phase. After the distribution phase, prices crash as selling pressure increases. Panic selling by retail investors leads to sharp declines, and weak hands exit the market. This phase can last for months or even years before a new accumulation cycle begins. Example: in 2017, Bitcoin rose from $1,000 to $20,000 before crashing back to $3,000 in 2018. A similar pattern repeated in 2021-2022 when Bitcoin went from $8,000 to $69,000, then crashed to $15,000. Part 2. Why cryptos pump. Fundamental reasons behind bull runs. Key factors that cause a pump. 1. Bitcoin halving. Supply shock. Bitcoin halving is an event that happens every 4 years, where the mining rewards are cut in half. This reduces the number of new Bitcoins entering circulation, causing a supply shortage. As supply decreases and demand remains strong, prices tend to rise significantly over time. Example: in 2020, Bitcoin's price was $8,000 before halving, and pumped to $69,000 by 2021. 2. Institutional buying and corporate investments. Large institutions and corporations investing in Bitcoin create huge demand, driving prices up. When companies like Tesla and MicroStrategy buy Bitcoin, it signals confidence in the market, attracting more investors. Example: in 2021, Tesla invested $1.5 billion in Bitcoin, causing a rally from $38,000 to $64,000. BlackRock and other financial institutions buying Bitcoin ETFs further fuel demand. 3. Economic crisis and inflation. Hedge. When fiat currencies lose value due to inflation, people seek alternative assets like Bitcoin. During times of economic uncertainty, Bitcoin is seen as a hedge against inflation, driving its price up. Example: during the 2020 COVID-19 crisis, excessive money printing led to Bitcoin's rise from $4,000 to $69,000. 4. Media hype and FOMO. Fear of missing out. Positive news and widespread media coverage can trigger a buying frenzy. Social media influencers and crypto analysts hyping Bitcoin often cause retail investors to jump in, pushing prices higher. Example: Elon Musk's Dogecoin tweets in 2021 helped Doge rise 10,000% in 6 months. 5. Positive government regulations. Government adoption and regulatory clarity can boost Bitcoin's legitimacy, leading to increased investments. Example: BlackRock's Bitcoin ETF proposal in 2023 led to a price surge from $25,000 to $48,000. 6. Whales manipulating prices. Whales, large holders, often manipulate prices by creating artificial demand or supply. They accumulate Bitcoin at low prices and then push the market up before selling at the peak. Example: in 2021, whales pumped Bitcoin to $64,000 before selling, causing a crash. Part 3. Why cryptos dump. Fundamental reasons behind market crashes. Key factors that cause a dump. 1. Interest rate hikes and stronger. US dollar interest rate hikes. Central banks, particularly the US Federal Reserve, can raise interest rates to curb inflation or stabilize the economy. Higher interest rates generally make safe assets like government bonds or savings accounts more attractive than volatile assets like cryptocurrencies. Impact on crypto. When interest rates rise, investors typically move away from riskier assets, like Bitcoin or altcoins, to safer investments with better returns. This can lead to a significant sell-off in the cryptocurrency market. Example: in 2022, the Federal Reserve raised interest rates multiple times to fight inflation, which led to Bitcoin's price falling from around $69,000 to $15,000. As the dollar strengthened, Bitcoin and altcoins faced pressure due to reduced liquidity and decreased demand. When to buy? During market corrections, interest rate hikes often trigger a correction, which can present a buying opportunity for long-term investors. Prices tend to stabilize after initial shock reactions. You should buy when there's a clear sign of recovery after a rate hike or a long-term downtrend. Signs of stabilization. Look for lower volatility or a slow, steady increase in price after the initial dump. 2. Exchange collapses and scandals. Exchange failures and scandals. When a major cryptocurrency exchange collapses or is involved in a scandal, like fraudulent activities or poor management, it creates a crisis of confidence in the market. Users panic and withdraw their funds, leading to massive selling pressure. Example: the collapse of FTX in 2022 triggered a major market crash, causing Bitcoin's price to fall from $21,000 to $15,000. Similarly, the Luna crash in 2022 saw Luna go from $119 to zero, wiping out billions of dollars. When to buy after market panic? After such a significant event, prices often drop drastically due to panic selling. However, if the cryptocurrency market as a whole remains functional and there are no other major problems, it might be a good time to buy during this panic-driven dip. Caution: always do your own research to ensure that the issue doesn't affect the broader crypto market, especially before jumping into buying. 3. Government bans and regulations. Bans and restrictions. When a country bans cryptocurrency or imposes severe restrictions, it causes a panic sell-off as investors fear that these policies will spread to other countries. Governments may take such actions due to concerns about illegal activities, energy consumption, or financial stability. Example: China banned Bitcoin mining in 2021, which caused a massive price drop. Bitcoin's price fell from $64,000 to $30,000 after China's ban, as investors feared other nations might follow suit. When to buy during fear of ban. If a government proposes or enforces a ban and the market reacts with extreme fear, it could lead to a price crash. However, not all bans are permanent. For example, after China's mining ban, Bitcoin's price eventually recovered as the market adapted. Look for recovery. Buy after the market has processed the news and starts showing signs of stability. Additionally, countries like El Salvador have embraced Bitcoin as legal tender, which can be a positive counterpoint to negative regulatory news. 4. Whales taking profits. Whale activity. A whale is a person or entity that holds a large amount of a specific cryptocurrency. When whales decide to sell off a significant portion of their holdings, it creates massive selling pressure. This can lead to sharp declines, especially if the whale dumps their position suddenly. Example: in 2017, Bitcoin reached an all-time high of $20,000 before crashing to $3,000. A significant factor in this crash was that whales and large institutions started taking profits at the top, dumping large amounts of Bitcoin and causing a steep decline. When to buy during whale profit-taking. Often, when whales start selling, it can cause sharp, sudden drops, but these may not be the end of the market. As long as the underlying technology and fundamentals remain strong, these dips can provide buying opportunities. Watch for bounce back. If you notice that prices start to recover after the initial dump, it could be a sign that the selling pressure has subsided and a buying opportunity may present itself. 5. Hacked exchanges and security breaches. Security breaches. If a major cryptocurrency exchange is hacked or suffers a data breach, it can lead to panic selling as people worry about their funds' safety. The crypto market is particularly sensitive to security issues because the entire industry relies heavily on trust and the integrity of exchanges. Example, in 2014, the hack of Mt. Gox, one of the largest Bitcoin exchanges at the time, resulted in the loss of 850,000 BTC. This event caused Bitcoin's price to plummet from $1,200 to $200 over a period of months. When to buy post-hack market recovery. Once the hack is resolved and security measures are enhanced, the market may begin to recover. If the breach is an isolated incident and doesn't affect other exchanges, it can create a buying opportunity at discounted prices, especially if the long-term outlook for the cryptocurrency is strong. When to buy. During dump phases, now that you understand the fundamental reasons behind crypto dumps, here's when you should consider buying during these events. Buy during market corrections. Market corrections are natural, and they can provide great opportunities to buy quality cryptocurrencies at a discount. After a strong dump, prices often become more reasonable for long-term investments. Look for post-panic recovery. After an initial sell-off or event-driven panic, e.g., exchange collapses, government bans, the market tends to calm down and stabilize. If the fundamentals of the cryptocurrency remain strong, it can be a good time to buy during the dip when others are selling out of fear. Watch for signs of market stabilization. Look for key technical indicators, RSI, MACD, moving averages, showing oversold conditions. When combined with positive news or continued adoption, this could signal that a cryptocurrency has hit the bottom of its cycle. Diversify your purchases. During times of fear-driven sell-offs, some cryptocurrencies might be oversold. Diversify by spreading your investments across a few fundamentally strong assets to minimize risk. Key takeaways: interest rate hikes, exchange collapses, government bans, whales taking profits, and security breaches are key reasons behind cryptocurrency dumps. Buy during market corrections, when prices have dropped significantly, but look for signs of stabilization and long-term potential. Follow the news and regulatory updates closely, as these events can provide opportunities to buy at discounted prices after a market-wide panic. By understanding these fundamental factors, you'll be better equipped to buy the dip when the market is in panic mode and take advantage of opportunities while minimizing risk. And if you liked the video, don't forget to hit the like button, subscribe to the channel,